you for staying with us. You're watching Market Guru. Chakri Lokapriya is our Market Guru today. He is with TCG Advisory Services. Chakri, always a pleasure to speak to you. So, just before we started the program, Chakri and I had a very interesting discussion. Usually what happens is if you're an investor, let's say in the US or something, and, this whole business of shutting Mauritius, if for some reason you have to pay a tax in India, you get a credit, let's say in US. But this doesn't apply, interestingly, if you were an endowment fund. So if you were the Harvard endowment fund or a pension fund, then you just simply end up paying taxes and you don't get that benefit. So Chakri, you brought up an interesting point. How much of this money are we talking about? Because for them, it actually means that they have to reduce their returns by 7.5% the first year, and after the next year, it will be down by 15%.
You're absolutely right about that. So far, we didn't have a short-term capital gains tax. And if you actually look at it, creates an unlevel playing field because Indian domestic equity mutual funds have zero capital gains, short-term capital gains tax. And therefore, by introducing a short-term capital gains tax on FIIs or FPIs, you are in essence, on equity funds I'm talking about, you are creating an unlevel playing field. And on the other hand, there are certain, like you mentioned, tax-exempt institutions like endowments who do not have a tax to pay in their home country. So by paying a short-term capital gains tax starting at 7.5 going to 15, and then they cannot, there is no mechanism for them to claim back the tax from their home country jurisdictions. So this creates a dampener. On top of that, of course, you have a currency risk.
So what you're saying is if I was a California Teachers Retirement Fund or CalPERS, whatever they call it, then, of course, the Harvard Endowment Fund, these guys will face a straightaway tax, which means they end up paying this tax here, nothing happens to them there.
Indeed, absolutely right. Okay. They will now start to pay a short-term capital gains tax, which they have not paid so far, and there is no way for them to claim that back.
Mm-hmm. So, Chakri, you must have seen a lot of these conferences are going on, some investment banks conference. And of course, there's a big conference market that we don't realize, which floats around the US every month. Okay, conference is one thing. Everybody arrives here, enjoys the sights and sounds of Bombay. But I don't see the money flow coming through. I mean, we're still running some 300, 400 million per day run rate after 2,000 FIIs. I mean, nothing to write home about. Why is that? I mean, everybody's visiting, but no money.
I think we are all waiting for the return of corporate earnings growth. So far, the benefit of this latest quarter's uptick came from a margin improvement because of a fall in commodity and oil prices, and not a demand uptick. So while it's a good thing that the earnings are bottomed out, a return of growth is more important for the markets to move sustained up from here.
Mm-hmm. And Chakri, of course, there are many kinds of rallies. One rally is when you become an investment team, and we've seen that sometimes it happens to Vietnam. At one time, it happened to us. Then, of course, the Asian tigers went up, I think, 10 or 20 times when they became a team. Then you have markets that just run up because everything else is running up, because there's enough money chasing commodities. This rally almost entirely belongs in the class where everything was running up, so we ran up. But I don't see then the differentiator that, there is a growth story here, so I'm putting the money. It seems like I'm putting the money, so I'm just going to put it everywhere that it goes. When does that change, and does it change?
I think that change will come to India, fortunately, because of a fall in both commodity and oil prices. Whilst they have rebounded in the past few months, they're still way off. Oil was $115 about 16 months ago, and now it's about $50. Mm-hmm. So the input prices and being an import country, it benefits. Mm-hmm. And also commodity, because a bunch of industries benefit from that. Now, so which means better margins, greater profitability, and even if there's a marginal uptick in demand, mm-hmm. you will see money coming to India rather than other oil-dependent, right. Commodity-dependent countries.
Mm-hmm. Just in looking at investment themes ahead of this, Chakri, I'm just wondering, a number of these infrastructure companies have really turned into penny stocks. Maybe partly because it's dividends, debt. But then I think it's also unfair to have them report everything on a 3-monthly basis because projects take years to complete. Would you be comfortable buying into some of these infrastructure companies that have annuity projects, like roads and ports and what have you, but it may be 3 years away at this point, because some of them are just simply penny stocks.
I think there are two things happening. For roads that you mentioned, roads have seen a pickup where roads are now being constructed at 20 kilometers per day, which is the highest number ever. On the other hand, if you look at stalled projects, continue to remain stalled. They now represent 8% of GDP. That's a big number. And for various reasons, not which are company specific, environment clearances have not come, courts cancel mines, and various regulatory issues, last mile issues. And so capacity utilizations are very low. And India calls itself power surplus when more than 35% of the population do not have electricity. Right. So these are all long-term issues. So there is no quick fix, right, unfortunately. And so these stocks is going to be a long grind.
Chakri, one of the challenges for the fund manager, of course, is that how do I turn all this economic growth into one trade? How do I get money out of this trade now? Yeah. So if I came to you and I said, Chakri, I'm expecting 15 to 20% in the Indian market since you're growing so fast, please give me some trade execution ideas. Is it aviation? Is it pharmaceuticals? I don't care what finally happens there, but I just want to make my 20%. For all I care, absolute fund investors are interested in it. Mm-hmm. Where are those ideas?
If we look at going out into 2017, we will see that banks and automobiles as sectors have one of the strongest earnings growth. They're going to grow at anywhere 30% plus year over year. Then you have some amount of industrials, which are not deep cyclicals, but shallow cyclical industrials are going to grow probably 45%. Mm-hmm. And banks, as we know, have been battered for various well-known NPA reasons. They're all trading at extremely dirt cheap valuations. So I think that's a good more than 20% plus return trade over the next 1 year or so. And several services companies, media companies, and beneficiaries of fall in oil and commodities such as paint companies, textiles. They all will, and petrochemical companies, plastic companies. I think all these guys will generate 20% plus returns over the next 1 year.
So you brought up an interesting point. Let's just look at the banks now. If you just go by the market cap of the banks, the PSU banks, I mean, all of them combined couldn't make up for HDFC Bank, I think, leaving SBI. Maybe I can include SBI also. I mean, that's the condition right now. So are you talking about PSU banks that if you're looking for a 20% hit, you don't have to get into what their deal is. Whatever they do on the stock itself, you would be able to manage 20%.
Indeed, you're absolutely right. PSU banks clearly offer more value. Yes, they have more problems, which they need to overcome, NPA-related problems. But yes, PSU banks, right from the largest to many down the chain, offer significant return.
Okay. Then you brought up paint companies. And then I think we have about 5 or 6 listed paint companies. One of them is, I think, maybe an old legacy problem, but maybe pretty much out of the business. When you go to buy paints, paints is not like buying FMCG also. Right. I mean, you in fact pick up whatever is the best quality. So should do the first 1 or 2 biggest names actually gain the maximum traction in stock price, or do you think you have to go down the line?
I think the top 4 or 5 names in the paint companies, all of them will benefit. Sure. For 2 reasons. One is oil price fall from 100 to 50. Their raw material costs have come down dramatically in spite of the recent rise. Second, it's not just the paint inside, but also the cans. They're also made of various petroleum chemical derivatives. So transportation costs, logistics costs, storage costs, packaging costs have all come down. And second, if you look at paint companies get their demand both consumer as in building houses or apartments, and second as industrial. Real estate, as we know, has been in the doldrums for the last few years. Any marginal uptick, greater benefit for paint companies. Industrial paints, like for example, car manufacturers. You buy a Maruti car, it's painted with a paint company's paint. And so they will see greater demand as you see a revival of that demand coming in.
Let's talk about the currency, because for foreigners that has a very important bearing. So in the last 8 years, we've kind of dropped off 70%, I think. I mean, I'm starting at 40 benchmark maybe, so we can take 2008 or 2009. So if I was in the market and I looked at the Nifty and somebody told me to buy an index which was, I pretty much made no money. In that thought process, I approach you and I say, well, I've made no money in 8 years. What do I do, Chakri, where I can still make money in spite of the currency? Do you think the currency will appreciate or depreciate from this point onwards?
The very good question, in the sense that the currency has always depreciated from 1947 to now. And so I think for FPI investors and FI investors expect on an average 3 to 5%, 3 to 4% currency depreciation, but hope that the growth will be, returns of the stock returns will be higher than that. You make 15% returns, lose 4% on currency depreciation, you've still made about 11%. And I think so the whole turn in, or rather a stabilization of the space at which the rupee has fallen will happen as and when the economy picks up, and more than economy, corporate profitability start picking up, because higher corporate profits means greater taxes for this lovely government.
Let's take a look at power. And you brought up an interesting point about the fact that 35% people, but when you look at many of the IPPs, the independent power producers, and you go to one of the power exchanges, the quotation is about 2 rupees. Maybe it's 2 rupees 15 paisa, I don't know. I haven't looked at it lately. Many of these power projects were set up when we were talking about 7 to 8 rupees per unit. The question then becomes, as an investor, how do you stay in these power stocks, Chakri? Because you produce the power which is costing you maybe 5 rupees, and you're not able to sell it even at 2 or maybe at 2.15. How economical is it to buy the power stocks given the current power scenario in terms of pricing?
I think something has to give in terms of power stocks. Like you rightly mentioned, in terms of it's just not viable to have a long-term PPA assuming that there is no such thing as an inflation and this PPA will hold good for the next 20 years. You have to have enough mechanisms in place which take into the dynamics of falling and rising coal prices, inflation, etc. But these are not easy choices, and fortunately, because the corporate demand for power is low, because they're running at 60% capacity utilizations, you still have some leeway to figure this out. But there are no easy answers yet.
Okay. So here I am, I'm an endowment fund, I'm a pension fund, I'm speaking to Chakri and I say, Chakri, look, for the last 8 years I was in India, I lost 70% of my currency. I've really not made any money. I was just thinking, why don't I just buy McDonald's, Starbucks, Pepsi, Coke? All of them are growing in your economy. Domino's maybe. Yeah. And since they're making money out of you or the Chinese, and I'm very happy because I have no currency risk. Yeah. Is that an option you think is being looked at by investors? Because then money flow is still coming to play the economy, but it's actually heading somewhere else, not to these stock markets.
That's a very interesting question. I think a portion of the allocation that is designed to come towards emerging markets will continue to come, but we'll find those emerging markets where you see growth, because emerging markets, including India, currency depreciation is a part of the risk. And so if you then on top of that you add stuff like short-term capital gains, like the Mauritius tax treaty, it's an additional dampener. So stability of regulations key for emerging markets, and a return to growth, which I think the economy is bottoming out. So at least you'll begin to see greater top line growth translating to greater earnings growth and therefore higher returns.
Okay, let's look at this gold loan companies, and I'm only focusing on them because I happened to speak to one of them, and Chakri, they mentioned they were making about they were borrowing at about 10.5% and lending at about 23.5%. So we're talking about a spread of 12%. In many countries, this could end up being usury. I mean, you're basically charging anything you want from a guy who has actually no ability to argue with you. He's pledging his personal gold ornaments. Do you think they are under some kind of a risk, because it's become big business, some kind of a risk of regulatory control. We saw that in the US, credit cards used to charge anything, then they had to give what their annual percentage rate was. They had to disclose it right there. Do you think these guys are going to run into some kind of regulations because they're really catering to people at the bottom of the pyramid?
True. And one, in terms of, the reason they're able to charge this kind of margins is because nobody else is willing to lend to them. The big banks, the regular mainstream banks, have tried and not succeeded. And because of various last mile delivery or inability to connect with a customer, these guys know how to connect with a customer. And these are usually short-term loans because they want their gold back. The customer wants the gold back. And so they just, and the borrowers look at it in terms of the amount rather than the interest rate. They don't think through of what is the interest rate that they're paying. Now, second, I think RBI has now come up with some regulations which makes it clearer. So yes, there is a chance of a higher risk, but at least these companies are allowing one to bank the unbanked.
Okay, I wanted to speak to you about real estate stocks because we rarely get into that space. But before that, I want to tell you a story. One of the big builders in Bombay, and I just heard that story yesterday before, huge complex. And there's some issue on who owns the society. And the society has been thrown out by the court. Still, it goes around sending letters and collecting maintenance and hiring bouncers when they hold society meetings. I'm just bringing this as a narrative to put in perspective that sometimes people ask why real estate stocks are not doing what they do in China. But there's real serious issues about how these companies are being run and the practices they're employing to do stuff. Is there a chance that you can get that 20% on real estate, or basically they got to fix their house in order before any of that can happen?
I think real estate companies, at least the well-managed ones, they've all cut down their land bank, cut down their debt positions by selling off some of the land bank. But most of them across the country, across most markets, still have a decent amount of supply.
Sure.
So there is no pricing power for them. And second is the transmission of interest rates. RBI has cut rates, but banks have only passed on less than half of it. So the benefit for the end consumer has not translated into lower EMI payments. And so when that lower EMI payments happen, because majority of all real estate loans in this country are floating rate loans. So only when we see banks actually passing through what RBI has already cut, will you begin to see a sustained uptick for real estate.
Chakri, my question really was more with how institutional investors look at stock, which is clarity of management thought process, that practices are best practices around the world. I mean, some of the phenomena we see with real estate companies here happens nowhere in the world. Are they comfortable enough with the real estate companies to increase their investments at the moment? Can we get that 20% kind of return with real estate stocks?
Yes, I think so, with some of the well-managed ones.
Sure.
And also increasingly we are seeing greater transparency because of various real estate institutions, and eventually if the tax regulations become clear enough, we will also have REITs, real estate investment trusts.
Sure.
Now that will bring a huge amount of transparent practices into the real estate industry. So I think that we need to wait for that. But yes, there are several companies which follow decent practices.
Right. So let's talk about a sector where maybe going short may get you 20%, pharmaceuticals. Your thoughts? Basically, I mean, it's an investment team issue. Some of these stocks rose from just being 400, 500 crore company to, tens of thousands of crores. Is it time for them to structurally adjust? And could that adjustment essentially mean that you got to keep them out of the portfolio till they find a real valuation, so to speak?
See, pharmaceutical industry's majority of the earnings come from export earnings. And if you look at US, in spite of all the talk around the US companies are sitting with $1 trillion in net profits as of now this year, versus the previous peak of 2007 of about $700 billion. So, which means as the US economy continues to be strong, becomes stronger, pharmaceutical companies will continue to benefit. Various companies, pharmaceutical companies, have had company-specific issues, and because of higher regulatory, US FDA, etc. But I think as a sector, it's still a growth sector.
And when you say it's a growth sector, would you stick to those who basically derive most of their revenues from a regulated market? Because our own markets, there are so many price controls, that's very difficult to figure out. So, or are you talking about domestic formulations?
I think from the export, because like you rightly pointed out, India is a far more regulated market, price control market that way.
Let's look at the IPO market, Chakri. I mean, we've really not seen any significant pickup in IPOs. And we were speaking to an analyst in the morning, and he said maybe that's a sign of a nascent bull market. But I mean, a flip theory could be maybe it's a sign of a bear market, that or a peaking bear market, that nobody is doing an IPO. And the IPOs that are coming, interestingly, I mean, there's always an ethical domain and hospitals and pathological labs being listed. But, you know, we had some pathological labs and guys who take care of thyroid and stuff like that getting listed. What's your thought on that? Is it just they're getting the listings, the premiums because of the fact that they're the first or the second in the business? Because many of these guys have even managed close to $1 billion. You don't see in the biggest regulated markets in the world.
I think all the new types of companies, sectors that are being born is a welcome sign because, you know, it's a sign of the economy growing up in terms of demand for newer and newer things. And on the other hand, the IPO market last year, or rather this year, was probably the it was the strongest in the last 5 or 7 years. So, but still it's nowhere close to the peaks that you saw in the earlier business cycle. So there are a number of companies out there waiting for a stability in the markets. So I think the IPO pipeline is exceedingly strong. And given some amount of stability, we will see a number of listings continue in all these new sectors.
Right. So, Chakri, I think, you know, you have close to $3 billion. One of the challenges when you have, you know, it's easy to invest $5,000, you know, you can put it in a mutual fund and let it be. But when you start putting 100, 150 million somewhere, you really have to be sure that you don't lose your principal. Could you share with us 1 or 2 sectoral or investment themes where you will not lose your principal in 12 months? You can sleep easy. I'm not looking for big returns, but I don't want to lose my principal.
Sure. Again, one of our favorite sectors currently is petrochemical related sectors. Because, you know, again, same thing, oil price falling from 100 to 50. Their input costs have gone down. And therefore, these are all companies across the Neil Kamals of the world, of the Supreme, the Finolex Cables, the Finolex Industries. All of them, their input costs have come down dramatically because the economy is not yet strong. Demand uptick has not yet happened. So a combination of demand uptick plus lower input prices will see good, strong returns over the next 12 months.